With its proprietary portfolio footprint, Globalance Bank maps the real impact of wealth on economy, society and the environment. But what is the financial performance of such a positive footprint? The private bank has undertaken the world's most comprehensive study on the subject of investment performance and sustainability. The result is unequivocal. There is a positive correlation between sustainability and financial performance. This offers investors the potential for a financial performance based on a positive footprint. Thomas Pfyl, Head Investment Selection, puts it in a nutshell. One's wealth can generate a dual return. View our most recent Globalance Bank webcast for the key insights from this study.
Mr. Pfyl, you have analyzed for Globalance Bank the most important studies about sustainable investment. What are your results?
It's very easy. Sustainability performs. So we have found out that 90% of our studies that looked at sustainable investments had better performance or an equal performance compared to traditional investments. So let's look at the chart. We have separated all the studies in 3 groups: the better performer, the equal performer and the weaker performer. Our results showed that 57% of the studies reached a better performance, 33% an equal performance, and only 10% had a weaker performance. This is a very good result, and we clearly see sustainability performs.
Now, these are great results, but how do you measure this?
Yeah, there are different measuring criteria. Some of the studies, they use, for example, cost of capital. So they look at the interest rates the company have to pay for their debt capital. Other studies look at the operating income. So they look, for example, at the sales or the costs of the companies. And a third group looks at the market capitalization. So, for example, at the development of the share price.
You have analyzed many studies. What were your criteria for choosing these studies?
Yes, we wanted to know it in detail and found 160 studies on the topic sustainability and performance. To have a good quality, we set the following filter criteria. Let's have a look at the chart. The first criteria is the age. So we included only studies that were published after 1995. The scientificity was another important criteria. We only wanted to include publicly available studies. And the independence was another criteria. So we didn't include product providers or consulting firms' studies in our analysis. Last but not least, we didn't include meta-studies because we wanted to avoid duplications. The result were 76 studies out of these 160 studies which reached our high requirements. We looked all these reports in detail, so 2/3 of all these studies were American studies and only 4% came from Asian countries.
Are these positive results valuable for all asset classes?
Yes, we analyzed the results of different asset classes. So 3/4 of all studies were on equities, and the results were quite similar to the overall result. On the bond side, there were only 3 studies, but they were all positive. The alternative investments had 2 segments. One of them is microfinance. There were 2 studies and they were also positive. The 8 real estate studies were all positive. Some of them showed a higher rental income between 2 and 17% for sustainable real estates.
Could you please give us a concrete example of a study on equities?
Yes, there is a new comprehensive long-term study from Harvard Business School and London Business School. The Harvard study analyzes the long-term development of 180 US-listed companies over 18 years. The half of them are highly sustainable. The other 90 companies are less sustainable. Let's have a look at the chart and look at the results. What you see on the vertical is the value development of the two portfolios, and on the horizontal you see the time period. It is obvious that the highly sustainable portfolio is performing much better than the less sustainable portfolio. So if you invested 18 years ago $1 in the highly sustainable companies, you have achieved almost 50% higher yield compared to the low sustainable companies. So a clear outperformance of the sustainable companies could be proved.
What are the reasons for this better performance?
There are a lot of reasons, but I would like to highlight three main reasons. First, sustainable companies attract and retain high-quality employees. So, for example, Google, all the students are interested to work with Google. So a second reason is that sustainable companies are more innovative and more forward-looking. So Toyota is a good example, which invented the hybrid engines and grew to the largest automotive producer worldwide. A third reason is that sustainable companies are better prepared on operational risks. So, for example, ABB is a leader in the energy efficiency business and therefore very well prepared for the energy future.
Despite these good results, why do many people still think that sustainable investments do not perform?
Yes, that's what we ask ourselves at Globalance Bank. And we found an answer when we analyzed the single stock studies and compared them to the fund studies. I like to compare it a little bit, investing and cooking. If you want to make a soup, you can take a lot of very good ingredients, but if you take too much salt, or if the cook takes too much salt, then you cannot eat the soup anymore. And it's the same in the portfolio management. If the portfolio manager chooses or combines the sustainable companies in a wrong way, you have not good enough results or even weak results. So let's look at the results. On the chart we see the results for individual stocks compared to funds. The results of the studies on the individual stocks show with nearly 80% better outstanding results, whereas the studies of the fund reached only 19%. What is the conclusion of the results? The implementation in the asset allocation of a sustainable portfolio is very important. Principles of portfolio management, such as diversification, style effects, valuation, or the costs, must not be neglected and are the key for success.
Could you please give us an example for the application of these principles?
Yes, I want to show you the performance of 3 different funds in renewable energies. Let's look at the chart. On the chart we see on the vertical the value development of the 3 funds. The 3 years time period is on the horizontal line. These 3 funds are not, as the names indicate, only invested in renewable energy. They are just as much invested in themes like energy efficiency, smart grid or utilities, which have a very different risk profile. Accordingly, the performance difference with more than 40% over 3 years is huge. The final conclusion, it's therefore very important what's in the fund, not what it says.
So what does that mean for my portfolio? What would you suggest me to do?
Yes, first of all, again, sustainability performs, and indeed in all the analyzed asset classes. The implementation is very important in a sustainable portfolio, so it's important that you talk to a specialist in sustainable assets before you invest in this category. So we would be very happy to make you an investment proposal that we can show you as Globalance Bank how sustainability and performance goes together.
Thank you, Mr. Pfyl. I will consider doing this. Further information on these studies and the webcast you will find on the webpage of the Globalance Bank. Enjoy investing!